Okay, imagine having this like incredible personal trading assistant, one that never sleeps, never gets emotional, and processes market data faster than any human possibly could.
Yeah, it sounds futuristic, but that assistant is actually here now. We're talking about algorithmic trading bots,
Yeah.
especially how they're being used in crypto.
Right. And that's what this deep dive is all about, isn't it? Pulling back the curtain on these automated systems.
Exactly. We want to explore how they actually work, the kinds of tools and strategies they use, and maybe, most importantly, what it really takes to make them work effectively, especially in crypto, which is, notoriously volatile.
Our mission here is really to distill the key insights, maybe some surprising facts, from all the sources we looked at, academic papers, industry guides, even a really interesting Reddit thread giving that kind of boots on the ground view, give you that shortcut.
Yeah, get you up to speed quickly.
Yeah.
So let's start with the basics. Algorithmic trading, what is it really? Fundamentally, it's using computer programs, algorithms, to automate trading decisions.
That tireless assistant we mentioned.
Precisely. These programs analyze market data, they spot opportunities based on rules you've predefined, and then they execute the trades, all without direct human intervention at that moment.
And that's a huge shift from, traditional manual trading, which relies so much on human analysis, gut feelings, intuition.
And emotion.
Yeah.
Fear, greed, the cloud judgment. Algorithmic trading strips that away. It's purely quantitative, driven by numbers, by rules.
Which means it can trade at the best possible times and prices.
Or at least aims to. It exploits tiny market inefficiencies that, honestly, a human would completely miss. We just can't operate at that speed.
Like the classic arbitrage example you always hear about.
Yeah, perfect example. Spotting Bitcoin a fraction of a cent cheaper on, say, Kraken versus Binance. A human might see it, but by the time they log in, place the order.
The opportunity's gone.
Gone. A bot. It can see that difference, buy on Kraken, sell on Binance almost instantaneously. We're talking milliseconds. Physically impossible for us.
Okay, so that speed is a massive advantage. But beyond just being fast, why are these bots such game changers, especially in the crypto world?
Well, speed and efficiency are definitely critical in crypto because things move so fast. A tiny delay can cost you. But then there's the 24/7 operation.
Because crypto never sleeps.
Exactly. Markets are open around the clock, all time zones. A bot can keep trading, keep monitoring while you're asleep, ensuring you don't miss opportunities just because it's 3 a.m. your time.
Okay, that 247 thing, though, doesn't that also mean constant exposure? Like, what if something goes wrong while you were asleep? That sounds stressful.
It absolutely can be. That's why the risk management programmed into the bot has to be incredibly robust. You need those safety nets, those automatic stop losses or other controls. It's not entirely set and forget. You still need to build it right and monitor it.
Right, okay. And the emotion-free trading, that seems huge.
It's a massive edge. Bots stick to the logic, the data. No panic selling because of some bad news. No FOMO buying during a huge pump. It's disciplined execution, purely based on the rules you gave it. Even experienced humans struggle with that discipline.
And they're customizable too, right? You can tailor them.
Highly customizable, you can program incredibly specific strategies. Maybe you want to scalp tiny profits hundreds of times a day. Or maybe you want a bot that slowly builds a long-term position based on trend indicators. You can design it for your goals.
And it's not just for coding wizards anymore.
Not at all. Accessibility has really improved. Lots of platforms now offer pre-built bots, templates, visual strategy builders. It makes it much easier for people who aren't hardcore programmers to get started and experiment. These benefits directly tackle a lot of the challenges individual traders face in crypto.
Okay, so we have this fast, tireless, emotionless, customizable assistant. But what's actually inside? What's the intelligence? What are the common strategies these bots are running?
Right, the brains behind the operation. At their core, these algorithms are just sets of rules and instructions. They can range from pretty simple to incredibly complex. A really common one, a cornerstone really, is the moving average crossover.
Moving averages, yeah. Calculating the average price over a period.
Exactly. But the key in crypto often lies in the time frame. Traditional markets might use a 50-day or 200-day average. In crypto, because it moves so fast, a bot might use something much shorter, like a 1.7-day average calculated from 5-minute price data, like one source mentioned. It makes it way more responsive.
So a much shorter, more sensitive average, how does it use that to trade?
It's pretty straightforward, actually. It's looking for momentum. If the current price crosses above that short-term moving average, it suggests upward momentum might be starting. That's typically a buy signal.
And the reverse for selling.
Yep. If the price drops below the moving average, it indicates a potential downturn. The strategy triggers a sell signal, maybe moving funds into stablecoins or USD to try and preserve capital before a bigger drop.
That sounds like it could have saved people a lot of pain in past crypto crashes. I think one of the sources mentioned Litecoin in 2018.
That was a great example. A bot, using that kind of short-term crossover strategy, would likely have generated a sell signal. As Litecoin started its steep decline below its, say, 1.7-day average, while buy-and-hold investors rode it all the way down, the bot would have potentially preserved capital in USD, significantly outperforming.
And you can make it even faster.
Yeah, you can use an exponential moving average, an EMA. It gives more weight to the most recent prices, so it reacts even quicker to changes.
Okay, so moving average crossover is one key strategy. What else is popular if you want something maybe a bit more predictive?
Well, then you might look at mean reversion. It's sort of the opposite philosophy in a way. It also uses a moving average, but it adds upper and lower bands around it, maybe, say, 3% above and 3% below the average.
Bands around the average. What's the thinking there?
The core idea is that prices, even volatile crypto prices, tend to revert back towards their average over time. Think of it like a rubber band. If the price stretches too far away from the average, hitting one of those outer bands, the strategy assumes it's likely to snap back towards the middle.
So the bot tries to anticipate that snapback.
Exactly. It trades when the price hits those bands, betting on that reversal back towards the mean. It's trying to capture those smaller oscillations.
Interesting. So capitalizing on the tendency to return to the average, what other major approaches are out there?
Then there's pairs trading, which is quite different. Instead of trading a crypto against, like, the US dollar, you trade two different cryptocurrencies against each other.
Wait, how does that work? Trading Ether against Solana, for example?
Yeah, something like that. The goal is to find two cryptos that historically tend to move together. They're co-integrated. Maybe they're in the same sector, like two DeFi tokens. Even if they both go up or down, they tend to maintain a certain price ratio or spread between them.
Like they're linked somehow.
Kind of. So if one suddenly shoots up way more than the other, breaking that historical relationship, the pairs trading bot might bet that the relationship will return to normal. It might short the one that went up too much and go long the other one, expecting the gap between them to close.
Huh. So you could potentially make money even if the whole market is flat or even if one coin is generally trending down, as long as their relative price corrects.
That's the idea. It focuses on the relative value between the two assets, not just the overall market direction. It's a more market-neutral approach.
Fascinating. What else is common?
Well, we already touched on arbitrage, that high-speed hunt for tiny price differences across exchanges. Then there's market making.
Right, providing liquidity.
Yeah, market-making bots place both buy orders, bids, and sell orders, asks, just above and below the current price. They aim to capture the tiny difference between the highest bid and the lowest, ask the spread, while helping other traders execute their orders.
And trend following. That sounds intuitive.
It is. Probably the most intuitive. Identify an established trend price is clearly going up, or clearly going down and ride it. The bot buys in an uptrend or sells shorts in a downtrend, basically assuming the current trend will continue for a while longer.
Okay, that covers a lot of the strategic thinking. Now, for the people listening who might be thinking, okay, how do I actually build one? Or just want to understand the tech side better, what are the tools, the languages?
Right, the toolkit. Choosing the right tools is definitely key. And the language often depends on what you're trying to achieve. But honestly, the absolute go-to, especially for developing, testing, refining strategies, it's Python.
Python seems to dominate data science and finance these days. Why is it so good for this?
It's a few things. It's relatively easy to learn. It's very readable, which helps manage complex code. But the real power is its ecosystem of libraries. You've got Pandas for handling data like price histories, NumPy for math, scikit-learn if you want to dabble in machine
I
learning.
mean, specific trading libraries.
Oh yeah, things like TA-Lib or a newer one called Finta, which implements loads of technical indicators, moving averages, RSI, MEXCD, you name it. And they're designed to work directly with the data structures from Pandas. It makes coding strategies much faster. There are also full frameworks like Zipline, which was used by Quantopian for complex backtesting.
So Python is great for development, analysis, backtesting, but what if you need that absolute raw speed for arbitrage or really high-frequency stuff?
Then you're probably looking at C++.
Yeah.
It gives you much lower level control, it's closer to the machine, and it's just plain faster. If shaving off every possible microsecond matters, C++ is often the choice for the part of the bot that actually executes the trades.
Are there other languages in the mix?
Sure, Java is still huge in traditional finance. Apparently something like 85% of e-banking and trading systems use it because it's known for being very robust and reliable. And R is really strong for pure statistical analysis, data visualization, especially time series, and risk modeling.
So you might even see a mix.
Definitely. Sophisticated operations might prototype and do research in Python because it's faster development, but then implement their core super-fast trading engine in C++ to get maximum performance in live trading.
That makes sense. Use the right tool for the job. Now, within Python, especially for crypto, are there any must-have libraries?
Oh, absolutely. The big one, the real lifesaver, is CCXT, the cryptocurrency exchange trading library.
Why is that such a big deal?
Because every single crypto exchange, Binance, Kraken, Coinbase, Gemini, all of them has its own unique way of letting programs connect to it, its own API. Coding for each one individually would be a nightmare. CCXT acts like a universal translator.
So you write your bot's trading logic once.
Exactly. And CCXT handles the specific communication details for over 120 different exchanges. It abstracts away all those differences, saving developers an enormous amount of time and effort. It uses one consistent interface.
Wow, that sounds indispensable. But just playing devil's advocate, does using a translation layer like CCXT add any delay? Or maybe limit access to some really specific niche features of one particular exchange?
That's a fair question. For the vast majority of trading strategies, any latency added by CCXT is negligible compared to network latency or other factors. If you were doing extreme high-frequency trading where nanoseconds count, maybe you'd code directly to the exchange's native API for that tiny extra edge. And yes, occasionally an exchange might release a brand new complex order type that CCXT doesn't support immediately. But for probably 99% of users, the benefits of standardization and ease of use vastly outweigh those edge cases.
Okay, good to know. Any other key crypto tools in the Python world?
FreeTrade is another popular open-source framework specifically for crypto bots. It supports lots of exchanges, has built-in backtesting, plotting, you can integrate machine learning models. It even lets you control your bot via Telegram, which is kind of neat.
Control it from your phone, basically.
Yeah. Then there's yfinance for pulling historical data easily from Yahoo Finance. And backtrader is another widely used Python framework for backtesting and live trading. It has a very active community, which is always helpful.
What about pushing the boundaries? Using AI in more novel ways?
Well, there's TensorTrade, which we mentioned briefly.
Right.
Uses deep reinforcement learning, basically. The bot learns through trial and error, like teaching a computer to play a game. But the game is trading. It gets rewarded for profitable actions and penalized for losses, gradually figuring out strategies on its own. It's still developing, but very interesting.
Learning by doing, essentially.
Right. And then there was that surprising example, Trump 2 Cash.
Ah, yes. The algorithm reading Trump's tweets. What was the key takeaway there for crypto?
It wasn't really about Trump specifically. It was about demonstrating that you could extract tradable signals from unconventional, unstructured data sources, in that case, Twitter sentiment about specific companies. The core idea is adapting that. Imagine a bot monitoring thousands of Telegram channels, Discord servers, crypto news feeds, project announcements.
Looking for shifts in sentiment, hype, or FUD.
Exactly. Using natural language processing to gauge the collective mood or spot emerging narratives way faster and broader than any human could. That's social sentiment analysis, and it's a really active area of development for crypto algos.
Automatically trading based on the buzz. That's pretty wild. Now, related to getting real-time market info, you mentioned the order book earlier as being critical.
Absolutely crucial. The order book is like the real-time pulse of the market. It shows you exactly where the buyers and sellers are lined up right now.
So it's that list you see on an exchange. All of the buy orders, bids, and sell orders, asks at different prices.
That's it. It's a live, constantly updating list for a specific trading pair, like Bitcoin USD. And it's not just the prices people are asking for, but how many orders are at each price level. That gives you a sense of market depth.
Market depth.
Yeah, how much buying and selling interest exists right near the current price. Are there huge walls of buy orders just below the price, suggesting support? Or big sell walls just above, suggesting resistance? This tells you about liquidity too, how easily you can trade a large amount without massively moving the price against you. A deep order book means lots of orders, high liquidity.
And bots use this depth information, not just the best bid and ask.
Oh, definitely. They look at those walls as potential turning points. A big buy wall might mean the price bounces off that level. A big sell wall might mean it stalls there. But they also look for the opposite liquidity gaps.
Caps, areas with few orders.
Exactly. If there are very few orders between the current price and a price significantly lower, it means if the price starts dropping, it could fall very quickly through that gap until it hits the next batch of buy orders. Bots can use this to anticipate volatility or manage risk. This order book data is fundamental for strategies like scalping, support resistance trading, and even spotting dodgy stuff, like spoofing.
Spoofing? You mean fake orders?
Yeah, placing large orders you have no intention of executing, just to create a false impression of supply or demand and manipulate the price. It's illegal in regulated markets, but you might see attempts in crypto. Analyzing order book dynamics, seeing large orders appear and vanish instantly can sometimes help bots detect this.
How do the bots get this data so fast?
Directly from the exchange APIs, or through specialized data providers who aggregate feeds from multiple exchanges. Some tools also offer visualizations, like heat maps, to help humans see the order book depth. It really is the bot's eyes and ears on the market, second by second.
Okay, so we've got the strategies, the tools, the data feeds, like the order book. Now let's get practical. Someone wants to actually build and deploy one of these. What does that process really involve, and what are the maybe unspoken challenges? The hard truths.
Right, the journey. Look, it definitely takes technical skill, careful planning, resources, but it's not impossible. The very first step, and honestly maybe the most important, is defining your objectives. What exactly do you want this bot to do?
Be specific from the start.
Crystal clear. Is it scalping tiny profits? Is it arbitrage between two exchanges? Is it a long-term trend follower? Is it focused on risk management for your portfolio? Without that clear goal, you're just coding blind.
Okay, goal defined. What's next?
Choose your language. Python is often the practical starting point. Then select your platform, your exchange. You need one with a reliable, well-documented API. Think Kraken, Binance, Coinbase Pro. Those are common choices with good APIs.
Get that connection to the market set up.
Then the core development. This is the heavy lifting. Coding how the bot analyzes data, how it generates signals based on your chosen strategy, how it actually places orders using the exchange's API, and critically implementing robust risk controls.
There's that risk management again, non-negotiable.
Absolutely non-negotiable. Stop losses, take profit targets, rules about how much capital to allocate to any single trade, position sizing. These safety nets are vital. You have to build them in from the start.
And this is where AI might come in for more advanced bots.
Yes. This is where you might integrate AI. Maybe using machine learning to help predict price moves, or deep learning to let the bot refine its strategy over time, or NLP for that sentiment analysis we talked about. And naturally, you need a secure way to handle the crypto assets, a secure wallet system integrated with the bot.
Okay, so you've coded the bot, you've built in the risk controls, it exists. Now comes the crucial part you mentioned earlier, testing. How does that actually work?
Testing. You absolutely cannot deploy a bot with real money without rigorous testing. The first stage is backtesting.
Running it on historical data?
Exactly. You feed it past market data, months, maybe years worth, and see how your strategy would have performed. Did it generate profit? What was the risk like? What were its biggest losses? It gives you a first baseline.
But you mentioned backtesting has flaws. What are the big ones people need to be aware of? That Reddit thread hit this hard, right?
Yeah, and it's a really important point that experienced traders always emphasize. Backtesting is essential, but it's not reality. Historical data might miss nuances, like the exact order book states second by second. More importantly, backtests often assume perfect execution.
Meaning they assume your trades happen instantly at the exact price in the data.
Right, which almost never happens. In the real world, there's slippage. The price moves slightly against you between when your bot decides to trade and when the order actually fills. Especially if you're trading larger sizes, your own orders can impact the market price. Backtests usually don't account for this perfectly.
So the simulation is too clean. What's the next step to get closer to reality?
Live testing or paper trading. You run your bot in the current live market, but using fake money or connecting it to an exchange's test environment, a test net. It sees real-time prices, experiences real network delays, latency, interacts with the live order book dynamics, but without risking your actual capital.
Okay, that bridges the gap. And then the final hurdle.
Forward testing. This is where you run the bot live with a small amount of real money, maybe just $100, like that Reddit trader suggested. There's simply no substitute for seeing how it performs with actual skin in the game, dealing with real latency, real order fills or partial fills, and real trading fees. This is the ultimate validation.
And when you're evaluating how it's doing in backtesting or forward testing, it's not just did it make money, what metrics really tell the story?
Profit and ROI are obviously important, but they don't tell the whole story. You absolutely need to look at risk-adjusted returns. The Sharpe ratio is key for this. It measures your profit relative to the volatility or risk you took to get it. Higher is better.
Getting paid well for the risk you're taking.
Precisely. You also look at the win-loss ratio of your trades, the profit factor, total profits divided by total losses. And specific risk measures are vital. Value at risk, or VAR, tries to estimate your maximum potential loss over a certain period with a certain confidence level.
And maximum drawdown. That sounds important.
Hugely important. Maximum drawdown is the biggest percentage drop your account experienced from a peak value down to a subsequent low point during the testing period. It shows you the worst losing streak your strategy encountered. Knowing this tells you if you could realistically stomach that kind of loss psychologically and financially.
Understanding the worst-case scenario. Now let's circle back to that Reddit thread. The experienced trader shared some real hard truths. What stood out?
It was fantastic, real-world stuff. First off, algos are not magic money punters. Consistently profitable ones usually make small, steady gains, not lottery wins. This really cuts through the hype you see online.
Manage expectations. Got it. What else?
Costs are killers. This came up again and again. Transaction fees, slippage, the bid-ask spread. These things can absolutely destroy your profitability compared to the backtest. If your strategy only makes tiny profits per trade, these costs can easily wipe them out. Minimizing them is a constant battle.
And how do pros fight that battle? You mentioned liquidity and order types.
Yeah, they focus on exchanges with lots of buyers and sellers, deep liquidity, and low fees. They use limit orders, which specify the price you're willing to pay, rather than market orders, which just take the current best price and can have high slippage. They refine the bot's logic to trade patiently, maybe breaking large orders into smaller pieces. They also stressed lowering latency, keeping the time between decision and execution under 10 seconds for short-term trades. That's tight.
That 10-second window really highlights the technical challenge. What about the day-to-day reality of running these?
Big one. They are not set and forget. Never. They require daily checks, monitoring, maybe restarting things, handling errors. It's not passive income in the way people sometimes imagine. It's active system management.
And the market itself changes.
Constantly. The market might be trending strongly one month, then choppy and sideways the next. A bot designed for trends might lose money in a sideways market. So the trader needs to be able to identify the current market regime and potentially switch strategies or just turn the bot off if conditions aren't right for its logic. The human manager is still crucial.
So the human steers the ship, even if the bot rows the oars. Did they find the bots ultimately did better than their own manual trading?
Interestingly, yes, generally. The main reason. Eliminating emotional mistakes, especially on the exit. The bot follows the rules, cuts losses when the stop is hit, takes profit when the target is reached. No second guessing, no fear, no hope messing things up. That discipline was the key advantage.
Discipline again. But then the sobering part. How long does a winning strategy actually last?
This was maybe the most eye-opening point. Even a highly successful algorithm might only work well for, quote, a couple of months before the market dynamics shift, or other traders figure out the same edge and compete it away.
Wow, only a couple of months.
That's what they found. It means you need to be constantly researching, developing, and testing new strategies to stay ahead. It completely busts the myth of finding one magic algorithm that works forever. It's an ongoing R&D effort.
That's a serious commitment. But was there good news for people starting out?
Yes, definitely. They stress that you can start small. You don't need tens of thousands of dollars. You can realistically build, test, and even run a bot live with a very small amount, like $100, just to learn the ropes. The barrier to entry in terms of capital is quite low.
So it's accessible to experiment.
Very accessible. And they also mentioned the hybrid approach is viable using the algo outputs as sophisticated signals or indicators, but having the human make the final call on the trade, combining the strengths of both.
Automation as a co-pilot, not necessarily the pilot.
Yeah.
Okay, pulling this all together and looking ahead. With AI advancing so rapidly, what's the future look like for algorithmic trading?
It's definitely heading towards more AI integration. Expect algorithms to become more autonomous, learning, adapting, maybe even discovering completely novel strategies with less direct human input, potentially truly self-sufficient bots.
And AI's role in risk management, you mentioned it could be more dynamic.
Way more dynamic. Instead of just a fixed stop-loss price, an AI could constantly monitor dozens of factors. Volatility spikes, thinning liquidity on the order book, correlations changing, news sentiment, and adjust the risk parameters in real time.
Like tightening stops automatically if things get choppy.
Exactly. Or reducing position size, or even automatically hedging the position if risk levels cross a certain threshold. Think of it like smarter adaptive safety nets that react intelligently to changing conditions. It's like applying control systems theory from engineering trade. Observe the market reaction, learn, adjust, continuous feedback loops.
Self-improving safety. Looking further out. Quantum computing, is that relevant here?
It's still pretty far out, but yeah, it's fascinating. If quantum computing becomes practical, the sheer processing power could blow current limitations away, the complexity of models, the speed of analysis. It could completely revolutionize the field. Quantum trading bots sound like science fiction, but it's on the horizon.
Mind-bending possibilities. And are these trends AI, sophisticated algos specific to crypto?
Not at all. While crypto is often a testbed because it's newer and less regulated in some ways, these advancements in AI and algorithmic trading have huge implications for all financial markets. Equities, forex, commodities, bonds. Expect these sophisticated approaches to become more prevalent everywhere.
And the regulatory side, that must be a big piece of the puzzle, especially in crypto.
Oh, absolutely critical. The rules are still evolving, and they vary a lot from country to country. Staying compliant, using reputable and licensed exchanges, that's essential. And AI itself brings new regulatory questions. How do you ensure fairness? How do you ensure transparency if the AI's logic is like a black box? Who is accountable if an AI makes a disastrous mistake? These are big issues regulators are grappling with.
Definitely a lot to consider there. Wow, this has been incredibly thorough. We've gone from the basic definition through key strategies like moving averages and pairs trading, dug into the essential toolkit, Python, CCXT, all those libraries. We highlighted the vital role of the order book, then walked through the nitty-gritty of actually building, backtesting, and deploying these bots.
Yeah, hitting those hard truths about costs, slippage, the need for constant monitoring, and the limited lifespan of strategies. That real-world perspective is so important.
And we looked at how AI is really changing the landscape, both for finding opportunities and, crucially, for that dynamic risk management. Plus, a glimpse into the future with quantum and the ongoing regulatory evolution.
We covered a lot of ground, for sure. It's a complex but really fascinating area.
It really is. So to leave everyone listening with something to chew on, as this partnership between human intelligence and artificial intelligence gets deeper and deeper in trading, especially in crypto, what kinds of completely new strategies or market efficiencies might emerge? Things we maybe can't even properly conceive of today. Definitely something to think about as you continue exploring this space.